Hey, welcome back to Stone Cold Investors. My name is Jesse, and today I'm going to be going over Crocs. But before I do that, check out the description. I've got a timeline of the video and the content related to it. So if you want to skip ahead to certain sections, feel free to do that. These can get a bit long, so hopefully that helps out. All right, so here we got the 5-year chart. We can see it started off about $8, got up to about $40 before the COVID crash. It came back down during the COVID crash to about $10. And then continued to just rocket up to 180 as we rebounded through COVID. And the business saw a ton of tailwinds. Some of their fundamentals were just amazing during this time. Since then, we had the HeyDude acquisition in here. And since then, kind of dropped and then just continued falling back down to these previous levels, bouncing a little bit, falling, bouncing, falling. And it got down to about $45, just above like $48 consolidated for a little bit, and it looks like we might be bouncing back into earnings on, I believe, Thursday. So we'll see how those go. I was thinking about releasing this, we're doing a video after earnings, but in the grand scheme of things, earnings is just a single time data point for different metrics. The valuations I do on a previous 5-year basis and looking forward 5 years, I don't know, one quarter isn't going to change it too drastically unless something really crazy happens. So that is the chart. And with that, let's get over to the latest investor presentation. All right, so here is the Q1 2022 investor presentation that is going to be outdated in a couple days. So here we just have a quick note from the CEO saying, growth, the year over year looks good, and kind of reaffirming the demand for the brands of Crocs and HeyDude, which was a recent acquisition. Demand is remaining strong, and they actually upped guidance a little bit. So their outlook actually increased. All right, so here we got just different growth metrics for Q1 2022. Revenues grew 44%. Crocs revenues was a 19% growth. HeyDude revenues was 115 million. Crocs DTC or direct to consumer was 17% growth. Digital sales growth was 23%, and digital penetration 32%. And then here we have different revenue breakdowns for Q1. We can see the brand revenue between Crocs and HeyDude. Crocs was 73% revenue. HeyDude was 27%. We've got the geography breakdown of the revenue. North America 58%, Asia Pacific 18%, and EMEALA 24%. Digital penetration was 32%, and channels direct to consumer was 35%. All right, and then here we have a slide just of the Q1 2022 financial highlights. Revenues grew 47%. Gross margins actually decreased 580 basis points. Adjusted gross margins decreased 130 basis points. Adjusted SG&A percentage of revenue increased 60 basis points. Operating margin decreased 110 basis points. Adjusted operating margin decreased 70 basis points. Diluted EPS decreased by 19%. Adjusted diluted EPS increased by 38%. So something to keep in mind though, with these year-over-year comps, is that their margins are going to be changing as they ramp up the integration of HeyDude into the company. So the margins that they had just with the Crocs brand is going to be different than the margins that they're able to get with the HeyDude product line. So I expect those margins to kind of compress like we see here until they moderate. And then here we can kind of see the management's overall kind of plan to build the Crocs brand revenue to $5 billion plus by 2026 year end. And then they kind of have the same slide for HeyDude, getting HeyDude revenues to $1 billion plus by 2024. And then here we can kind of see them going on just to give Q2 and fiscal year 2022 guidance. So for Q2, which is coming up in a couple of days, what we should expect is total revenues in the range of 918 to 957 million. 718 to 737 million would be coming from the Crocs brand, while 200 to 220 would be coming from the HeyDude brand. They're expecting an adjusted operating margin of 26%. And they just have an adjusted one-time cost here of $65 million. They don't really go into tax rate or diluted EPS or CapEx for 2022 for Q2 2022, but we see that in fiscal year 2022, they're expecting about 3.5 billion total revenues. Crocs to be about 20, or I'm guessing that's Crocs growth of 20+%. HeyDude around 750 to 800 million. Operating margins between 26-27%, and adjusted diluted EPS of 10 to 1065, which is crazy to think they're potentially going to be able to hit $10 a share of EPS when the stock was trading at around $50 at one point. So here they give a brief description or a brief rundown of the capital allocation priorities. Business and investment, deleverage to under 2x gross leverage. And they took on a lot of leverage and a lot of debt for the HeyDude acquisition. I think it was around $2 billion. So it's quite large. And shareholder returns, they go on to say, share repurchases on hold until gross leverage is under 2x, which we do not expect to occur in 2022. And we're going to go into a little bit of the debt increase that the HeyDude acquisition had on the company. And from a valuation perspective, how the market kind of reacted to that debt increase for the HeyDude acquisition. And then we actually get a slide here of the leverage outlook, and we can see in 2021 is about 0.8x. And then because of the HeyDude acquisition, that went to 2.9x, and they're trying to get that down to under 2x by mid-year 2023. So if we get share buybacks and repurchases, it's going to be, in the tail end of 2023. Maybe hopefully they can ramp up their buybacks into 2024. But a big part of Crocs over the next couple of years is going to be getting that debt load, that long-term debt down. I think they're sitting at about like 2.8 billion right now, and about 2 billion of that was from the HeyDude acquisition. All right, and then the rest of the presentation is basically financials, but we'll be going over some financials in the evaluation section. Okay, so real quick, we're going to jump through the presentation they released when they did the acquisition. I don't want to spend too much time on this because a lot of the information that we digested in the Q1 2022 presentation is going to be kind of reiterated in most of this slide deck. But we can see here that they're saying, hey, we can go from Crocs to where we're right here to adding HeyDude, and then HeyDude and Crocs, and then it's a fast-growing brand. We can diversify our revenue streams into casual footwear, basically make the company a more broad-based shoe apparel company and have a longer runway for growth. And they say ideal fit with Crocs and long-term consumer trends. So they see a lot of synergies with the Crocs brand and being able to cross-sell between Crocs and HeyDude. And then we can see they're kind of looking at leveraging the Crocs playbook as far as the business playbook to kind of put HeyDude in the same position from a global scale. All right, yeah, and then here we can see the same kind of goal of building HeyDude revenue to 1 billion plus by 2024. And then they tried to sell us on HeyDude and why they're buying HeyDude to sell HeyDude. So that's good, I'm glad they're doing that. No, but I mean, it's just kind of the sales pitch to investors of, why this is accretive to the business long term and the opportunities that it's going to provide to the business long term. So now we got that out of the way. Let's go over and check out some different financial metrics and evaluation stuff. All right, so here we're hopping over to the evaluation model, and we can see on a trailing 5-year basis, got the 10-year treasury, which I use for the risk-free rate at 1.99% dilution. They've actually been doing buybacks over the last 5 years, about 2.48% average yearly buyback. Bottom line growth, they kind of went from that low profitability or low profit numbers into that tipping point of really adding profit to the bottom line. So that's pretty skewed up towards 94%, and that's not going to remain at 94% going forward, obviously, due to law of large numbers. So we go to the EBIT yield spread. Net yield spread and free cash flow yield spread, we got 2.43, 2.76, and 3.55. Okay, so let's go down and we will check out some of the different charting and metrics related to the company's previous financial history. All right, so here we can see just the gross profit, operating income, EBIT, net income, and free cash flow over the last 10 years. And we can see, going pretty much since, 2016, 2017, 18, 19, 20, and 2021, they've had pretty exponential quick growth. So they've really made a pretty big turnaround, and they've been able to grow the business pretty impressively over the last several years especially. But we always have to be aware of recency bias, and what happened in the last several years might not carry forward to the next several years. So there's always risk that we have regression in the business, and then instead of continuing this growth trajectory to where they want to get of about $6 billion in revenue, maybe they're not able to do it. But on a margins basis, we can see kind of the historical margin rate. It's around, around 60% lately, gross margin. And we kind of see that we had margins increasing as they became more and more efficient. And then now we're probably going to see a regression of the margins down a little bit lower as they take on the new HeyDude product. And that has kind of a drag on their overall margins due to the cost of production. But overall operating margins, we know that they say they're expecting around 26 or 27%, I believe. If we look at the historic bottom line yields on market cap, now this is kind of deceiving. And we'll go into this a little bit. So we can kind of see the spread between the yields on market cap versus the risk-free rate. We kind of had this regression in 2015. They started turning the business around, expanding, and then we got this pretty drastic increase to about 15% on net, 14% on EBIT, and 8% on free cash flow yield. Compared to 3.23% on the 10-year treasury. So they're yielding on the bottom line a lot compared to the market cap, but there's a caveat, because remember, we just went through that HeyDude acquisition. So the interesting thing with Crocs is that with any company, is whenever you have an acquisition or anything, it's going to probably take some time for the market to digest it and reprice the security. And you don't know if it's going to be repriced to the upside or the downside. In Crocs' case, it got repriced to the downside. And interestingly, we can kind of see that, when we look at the chart previously, there was a huge regression in stock price and in market cap, right? But because they took on so much debt, their enterprise value actually didn't decrease nearly as bad as what you would think compared to the market cap, right? So at one point, your enterprise value and market cap was right around 8.5 billion and 8.4 billion. And then currently, enterprise value is about 6.6 billion. And you're like, oh, that's not that bad, right? But most of that now is made up of debt. So their market cap is 4.4 billion. So what that tells me is obviously that the stock market did not take too kindly to the increase of long-term debt by 2 billion for the HeyDude acquisition. Now, we'll see what it plays out in a couple of years and how advantageous that is to the business overall. We'll see if it turns out to be a good long-term investment. Now, what we want to see as investors is we want to see that debt load that they got from acquiring HeyDude paid back quickly, right? Not only will it help our enterprise value, it'll kind of decrease, it'll help our enterprise value, but then it'll also diminish the risk from that long-term debt load, which I believe the equity markets would probably respond well to, right? So instead of share buybacks over the next year or so, it's going to be all about how fast and how quickly can they pay that debt down, that long-term debt. And the quicker that they can get that long-term debt from, 2 billion to, that's at long-term debt's at 2.8 billion right now. When they can get that to, sub 2 billion, sub 1.5 billion, and back into maybe the average, back to about 700, or back to 1 billion, 1.2 billion, because they're also growing. That's going to, I believe, in my mind as an investor, I'm going to look at that favorably. And I think the market might as well, especially if we continue to see steady growth in both of the brands while we have a decrease in leverage, and then the ability for them to additionally buy back more shares. So interestingly, I kind of wonder what the price action would have been like if they were not under this circumstance, because they're unable to buy back shares right now due to their debt leverage. So if they weren't as levered and they had the capital to be able to buy back shares instead of just focus on paying down debt, it might have provided a little bit of backstop to the security. I don't know if we would have seen a decline all the way down to 45 or 48, but that's here nor there. It doesn't really matter. Just kind of something interesting for me to think about. We can see that the historic shares outstanding has steadily decreased from 2012 on. So they've been a pretty constant buyback or repurchaser of their stock, returning more of the company and percentage of ownership to their shareholders. So that's good to see, and hopefully we see that continue quickly once they get that debt load paid down. Let's go into a little bit of my assumptions going forward as far as the evaluation and potential future fair values, or my estimated fair values based on the historical yield spreads, their revenue growth, their bottom line growth, and the potential future yield spreads along with the risk-free rate. So we'll dive right into this. For the risk-free rate, I have anywhere from 4.75% on a very bearish standpoint to 1.75% on a very bullish standpoint. On a dilution basis, I have anywhere from a 1% dilution on a very bearish standpoint to 3% buybacks on a very bullish standpoint. Bottom line growth, right? So this will be interesting. I have a very bearish case of negative 5% and a very bullish case of 15%. Management is guiding essentially into my bullish case right here at 10%. At least I believe they are. When we look at my bullish scenario, it would be at about 1.15 billion in net income, and that would mean that their operating margins would probably be around 26%. Actually, yeah, about 26%. And their net income would be about 20% on 6 billion of revenue. So that's basically if they meet their 5 billion in Crocs revenue, 1 billion in HeyDude revenue. Actually, HeyDude would be front loaded to the 2024, so it depends on if that growth can continue forward. But if they can meet their 6 billion in revenue and have about 20% bottom line margins, they would get to this 10% growth metric. So we've got 5% from negative 5% from very bearish, basically assuming that all that demand from COVID was front loaded. The brand is not going to be as wanted in the future, and they're going to actually see a regression and shrinkage of the popularity of the brand, and up to very bullish of 15% growth, and management target around 10%. So EBIT yield spread, we have a 5.2% yield spread on the bearish to 1.52% on the bullish. Remember, the larger the spread, the bigger the discount rate from the risk-free rate that we have, right? So if in our very bearish scenario, if we did have a 4.75% risk-free treasury yield and we had a 5.52% risk yield spread, it would mean that the security is going to be yielding close to like 10.25% to the bottom line on EBIT. So that is that is very high, 10% to the bottom line. So yeah, that would be a very bearish scenario. In net yield spread, we've got a very bearish spread of 5.83 and a very bullish spread of 1.83. Free cash flow, we have a very bearish spread of 6.7, and we have a very bullish spread of 2.7. Our base case is moderated at the historical 5-year average of the yield spreads. So the base case is basically saying, assuming management doesn't grow as much as they are projecting, but we get debt paid down, and we'll have to do that. We see these yield spreads, if we were going based off of enterprise value compared to market cap, this yield spread would be way further down. It'd be moderated. So in order to hit these yield spread targets on our base bullish and very bullish scenarios, we have got to see that long-term debt paid down to where their long-term debt is way under that 2x threshold and closer to their historical average of probably about 0.8 or 0.6x. All right, so if we go down to the bullish case, which I said kind of represented probably the closest of what management is guiding, if we just if I take some assumptions of their operating income guidance versus kind of their net income being about 5% lower than that, we see net income is about 1.168 billion in 2026. Estimated earnings before tax is about 1.06 billion, and free cash flow is about 823 million. So that's kind of my expectations of if management is able to hit their goals. Those are probably the numbers that they're going to be running into in 2026. And that's how I am calculating this bullish case right here. So we can see that currently, under my assumptions, and assuming all of my formatting is correct and my cells are correct and my, and my assumptions are correct, that the fair value across our different scenarios from very bearish is $70 and to very bullish is $653. Realistically, I could tighten this out a lot, but I usually like to keep some various cases that are just like kind of on edge scenarios to really know, okay, what am I dealing with? So even under a very bearish scenario, we're basically at the price that we are now, and we can see here that I really try to lay out the probability. So my very bullish scenario is about a 5, to me I'm saying is a 5% probability. The bullish scenario is 15% probability. I have a 50% probability on the base case and a 25% probability on the bearish case. 5% probability on the very bearish case. So just from my assumptions, which aren't going to be yours or any other investors, this is what I have to go off of. And we can see that the spread between fair value across all of these different assumptions are way different, 70 to 653. And as the company progresses and performs, I can look and kind of see where they are in my assumptions and maybe narrow these down eventually. So currently, if I am looking at a base CAGR of 20% and margin of safety of 10%, because this isn't really an industry that I'm super comfortable in. I'm learning more about it, but I don't have the highest comfort level, and I'm targeting 30% CAGR, which is ridiculous. That's ridiculous. I should probably do like a 5% margin of safety, 25, because 30% CAGR is just insane. So basically 5% safety, 20% target, and that means that even on my base case right here, if the base case comes true, we've got 25% CAGR stock appreciation growth into 2026, which would be a fair value target, my estimated fair value target in 2026, assuming the fundamentals persist and they meet those base case scenarios, of $224. So if we wanted to be super safe and wait for that bearish case, you'd have to get really, really low. Probably, let's see, 38. Yeah, around $38 to basically green through the bearish scenario, which I think that's actually got a pretty low probability of happening. Obviously, it getting to 38, I believe, has a low probability of happening, and the scenario playing out, I think, has a pretty low probability of playing out. So if we look at where it was around 48 at the recent lows, we had pretty good returns all the way through, even into the very bearish scenario. We had about 7.8% KGAR return. So just kind of showed you how discounted it was back when it hit into those low 50s, high 40s levels. But these are all my assumptions, and if I'm wrong, then none of this matters. And you know, it could go way lower, it could go way higher. We'll see what plays out. If you want to, like and subscribe. I'll be coming out with more evaluations on different companies in this format. And yeah, this is just a video journal of my progress of trying to figure out this investing thing. I'm a heavy index investor. I love doing valuation on individual stocks and looking at kind of like individual stock portfolios though. So I'm going to keep this up and just kind of document hopefully my growth and see where I mess up and try to improve and see if I can actually get somewhat good at this stuff. So hope you guys have a great day. We'll catch you later. Peace.